It was only a few months ago the shares of Disney were trading at about $80 per share. Now shares are trading over $110 per share. It looks like the company's trajectory is heading in the right direction. Streaming is getting better. The lost customers that they're experiencing in linear TV at least seems to be slowing down as they're cutting costs there. And obviously the future of the parks looks extremely bright. But we got an update from CEO Bob Iger this week. He was at an investment conference and gave a few really interesting insights into what they're seeing for the company and what might drive earnings going forward. One of the things that got a lot of attention in the media was the fact that he's really confident about the studio slate. That's going to remain to be seen exactly how that does. That's really a multi-year process to turn the studios around and have better content churning out. But they're starting to learn how to run the business. And I think that's fundamentally the most important part for investors is the business structurally set up to succeed? And then if the studios get themselves right and more and better content starts coming out, then that starts to be really the fuel behind the business. So I want to go through a few things that I think we learned from some of Iger's comments, even specifically about the quarter ahead and the quarter that they're going to be reporting in a couple of months. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Now, I want to cover a couple of things specifically, but the first is going to be about parks. And this is where I think we got the most indication of how parks are doing and what the vision is for that long term. And this is the quote from Iger. I put the whole quote up here, but I think the important part is highlighted at the bottom. I'm pleased to say that the trends for the quarter that we're in right now look like our domestic and our international parks and experiences business will probably deliver in the neighborhood of low to mid teens in terms of operating income growth. This is exactly what you want to see from Disney, and parks is really what's driving the business from a financial perspective right now. This is a look at Disney's experiences, revenue, and operating income. And this is trailing 12-month numbers, so this isn't the quarterly numbers. But you can see that there's been steady growth, and the company's on a pretty clear path to doing about $10 billion a year in operating income just from experiences. And this includes parks, it includes cruise lines. And this is exactly what Iger has said that they're going to invest more in the future. He talked about a new Pandora World in California. He said they're going to be building more cruise lines. There's a $60 billion worth of investment that's going to go into the parks business over the next decade. That's about double what they would normally spend on parks. So this is obviously an area where Disney is seeing a lot of momentum, a lot of profitability. And I think this makes a lot of sense for them to keep investing in this business. This is really the differentiation. There's going to be multiple companies in streaming. We're seeing the business decline in a lot of the linear TV networks. But parks is something where Disney really stands above the rest of the competition. And I always talk about this business as a waterfall. You start with the movie studio content, then that goes to linear TV, to streaming, and then eventually parks, which is ultimately where you're going to generate the most profitability from customers. But this isn't the only driver of the business going forward. And that's where Iger's comments about streaming and some of the momentum there, particularly bundling some of their products together, I think were really key to the future of the business. I'm going to start with a couple of quotes again. And I think these are really telling about what we're seeing with Hulu and Disney, and then eventually ESPN will be part of this. In bundling Hulu and Disney Plus, we're finding wherever we bundle, churn rates are down significantly. He says later on, with that obviously comes, I think, improved business results too. It's interesting, about 50% more of the new subscribers to Hulu are now bundling with Disney Plus. And where we have a bundled subscriber, we have a lower churn. One of the challenges for Disney in streaming is it's much easier to cancel your streaming service. And so if you're going to make a viable streaming service, you have to make sure you have your pricing right and you have your churn low, because it's very expensive to acquire customers. That's not really something they had to worry about in the linear TV business because it was just naturally growing over time. But in streaming, the challenge is you typically have a lot of churn, even on a month-to-month basis. Netflix has about 2% churn each month. So each month, about 2% of customers cancel. Disney's churn is in the 4 to 5% range. That's just unsustainable for that business long term. So you want to lower those churn rates. One of the ways you do that is by bundling products together. And that's why we see so much focus on Disney's bundles. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. These are the bundle options that Disney has right now. I think the one that makes the most sense to focus on is Hulu and Disney Plus. ESPN Plus is kind of a ancillary product. There is about 25 million subscribers, but it's not the full ESPN experience. And what you see here is you see some pretty compelling pricing options. $9.99 a month for Hulu and Disney Plus. This is with ads. Disney Plus alone would be $8. So for not all that much more money, you get Hulu included. You go to no ads, and from Disney Plus would be $14. This is $20 for the two of them. So you start bundling them together, and suddenly you get a better value proposition for customers, and that provides more predictability for Disney as a business. And this is something that cable has been doing for a really long time. There's not just one cable channel. There's dozens of cable channels. And yes, people get upset that they're paying for all kinds of different cable channels, but the cable company doesn't necessarily know what you want to watch specifically or your neighbor wants to watch. So they need to provide content for everyone so that everyone stays in the ecosystem. That's the challenge that a lot of these streaming companies have. And one of the answers is to bundle content together. That bundle gets even stronger in 2025 when they start adding ESPN over the top. We'll see exactly what that looks like. But you can imagine a bundle where you get Hulu, Disney Plus, and ESPN over the top. And now that suddenly covers the content that hundreds of millions of people potentially need. You lower churn, you increase prices, and just becomes a really strong business. And we're starting to see some evidence that the business is improving pretty significantly. The direct-to-consumer numbers in kind of this teal green color is what you want to focus on for streaming. And what I think is interesting here is this is already bigger business from a revenue perspective than the linear networks, than cable TV and ABC. So the upside is potentially quite a bit bigger for streaming, but it is a pretty costly business. You have all those marketing costs, you have churn costs. So you're seeing losses. A year ago, the loss was $1 billion in the first fiscal quarter of 2023. That was down to about $100 million in the most recent quarter. Bob Iger did say that that was going to be turning to profitability by the end of this fiscal year. And that's something they've been talking about making progress on for quite a long time. So it looks like this is moving in the direction, and a big reason for that is the bundling strategy that's really just starting to roll out now. So I think when you take a step back and you look at Disney's business, you have a really strong core with the parks and experiences business, operating income growing at low to mid teens. I think that's something that's going to continue probably for the foreseeable future, especially as they invest more and more in that business. And then the streaming business is improving quickly. We're seeing them raise prices, have pretty good success doing that. They're continuing to grow their user base of not only Disney Plus, but also Hulu with a number of distribution deals. Bundling appears to be working. And in the future, all of these things are probably going to improve as ESPN goes over the top. You're going to be able to bundle those things together, add more advertising. I just think there's a ton of momentum on the streaming side of the business from a financial perspective and from a growth perspective. And Iger highlighted a few of those things, also highlighted some of the strength in the parks and experiences, but I really like where Disney is sitting right now. It's one of those stocks that was very in love for a very long time. That was when I was buying shares, and I think there's still a lot of opportunity for this company as we see a lot of these businesses turn around and head to a growth trajectory, not only with revenue, but also on the bottom line. But what do you think about Disney stock? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.